Good morning, and thank you for joining us today. My name is Timothy Lee, and I'm a research analyst at Red Cloud Securities. I am delighted to host a Red Cloud webinar on gold exploration and mining today. We will hear from Alexander Scanlon, Managing Director and CEO of Barton Gold Holdings Limited. During today's webinar, he will provide an overview and outlook. Then we will take questions. You can type your questions into the chat box at any time, and we will get to as many as we can. Before we kick things off, first we need to discuss a bit of fine print. During this Barton Gold webinar, forward-looking statements may be made. I would direct listeners to the company's forward-looking statements disclosure outlined on page 2 of the Barton corporate presentation, and that can be found on the company's website, bartongold.com.au. For Red Cloud Securities, Inc., I would highlight that this webinar is for information purposes only. It should not be considered a solicitation or a recommendation to buy or sell securities. We note that this call does not consider the particular situation or needs of individual investors, and participants should rely on their own investigation and seek their own professional advice before investing. Please see our most recent research located on the Red Cloud website for specific disclosures pertaining to Barton. So a little background on Barton. This company has acquired a strong land position in a past producing area in South Australia. The company has multiple deposits with resources and has had exploration success, adding further ounces and identifying more targets to be drilled. As well, Barton is well positioned to move toward production as it owns a well-maintained mill in the region. With that, I now turn it over to Alex to update our audience on the company.
Great, thank you very much. So everybody should be able to see our latest corporate presentation on the screen there. And as Timothy just mentioned, the big news for us that we've announced quite recently, middle of last week, in fact, is that we've just had a significant resources update. So we have gone from 1.3 to 1.3 million ounces, 1.1 to 1.3 million ounces in our asset package. And before we step into the presentation, this image you can see on the cover here, this is not a stock image. This is actually a shallow, high-grade open pit mine we have at our Tarkula project. So it's quite relevant as we think about how we move from where we are today into stage 1 operations and then leverage that into growth in our stage 2 expansion. So as we'll go through the presentation, and of course I'll sort of take us through the detail, and then we'll make sure we have plenty of time for Q&A at the end. To sort of go a little bit deeper on what Timothy mentioned, in terms of who we are as a company, what we're doing and why we're doing it. We are a company that is sort of pure play focused on gold in South Australia. And South Australia is a very interesting state in Australia. So it has about 25% of Australia's known gold resources. So Australia, of course, is a very significant gold producer. People tend to think of Western Australia and Queensland as the gold producing states. That would be correct, generally speaking. But South Australia holds 25% of Australia's known gold resources and speaks for only about 2.5% of production. And that is really a legacy of a very significant investment and development focus in copper and uranium development. So South Australia is known as Australia's copper state. Major mining district where we are. On one side of the highway is a big copper district that BHP has just consolidated by acquiring Oz Minerals. On the other side of the highway is a gold district. And this is a gold district with about 130 years of production history, high-grade production. We have essentially consolidated the majority of all significant historical producing and exploration ground. That's brought together about 5,100 square kilometers of tenements, so very significant ground position. On that, we have now built a 1.3 million ounce resource base, and we do own the only gold mill in the region. So that's very strong leverage for us as we think about leveraging our own assets, but also as we think about future consolidation of additional economics in the region. Obviously, we are focused on the multi-million ounce potential of the region. We're not rushing that mill back into operations, but we're now starting to look at what does stage 1 operations look like. We are focused on the bigger picture. And so, it's a really clear strategy for us. We've made a lot of progress in the 21 months since our IPO, and a lot of upside potential. We have a very strong management team, and we are very well capitalized. One of the things that is a unique advantage for us, of course, is our asset platform. We're not just an explorer, we're actually an advanced asset manager run in part by experienced fund and asset managers. So we actually monetize these assets, and that's been a very valuable tool for us as we think about maintaining our treasury balance. Looking at our capital structure just quickly, we have a very tight capital structure, only 176 million shares on issue, so not something with billions and billions of shares. Today at our market close value of 25 cents per share, we're valued at around $43 million Australian market capitalization. And with our $8.3 million in cash, we have about a 35 million Australian market cap, or sort of low 20s, low to mid 20s if you're thinking in US dollar terms. Importantly, we have very strong alignment between the board and leadership and the balance of the shareholder register. So board and management speak for about 33% ownership in this company. And we have very, very strong support, a very tightly consolidated top 20 and top 50 shareholder register with some very good early institutional involvement in the company as well. So something that we focused on building up. And of course, thinking about that alignment between board and management and shareholders. This is why we're so focused on spending our money very carefully, but also refilling that capital by monetizing our assets. When we look at the leadership team, we'll touch upon this briefly, but really important to focus. We have a team that's not sort of just a standard exploration team. This is a team that in the senior levels alone, and we have more team than what's presented here. We have over 200 years of experience in exploring for, discovering, permitting, financing, developing, and operating assets with a very strong focus on gold and a very strong focus on South Australia. So I actually have 3 team members who are former Normandy mining. Normandy was Australia's largest gold producer until it was acquired by Newmont in 2002. Normandy was producing over 2 million ounces of gold. And my chairman, Ken Williams, was actually the CFO of Normandy. David Wilson and Mark Twining were also former Normandy and Newmont personnel. We have really strong corporate governance between Shannon Coates, our company secretary, who's also a qualified lawyer, and Christian Paik. He was the former general counsel and company secretary to Santos Limited, a major ASX-listed oil and gas producer. And then we also have mill specialization as well on our board and in our register. So Graham Arvidsson was the former general manager of operations and maintenance for Primero Group. They specialize in building and optimizing mills all around the world. They do an exceptional job. They're also a significant shareholder of ours. They own 4.2% of the company. So we literally have that expertise in the board and bolted into the company's shareholder structure. And lastly, my CFO actually was running uranium assets in South Australia for the subsidiary of United States defense contractor, which is possibly the most regulatorily complex thing you can do. And he's doing that in South Australia. So again, very, very strong pedigree, very broad and deep capability. And that really reflects our forward ambitions. And those forward ambitions are to build South Australia's largest independent gold producer. So again, a state that doesn't really have a primary gold industry, we are essentially leveraging these assets to reopen an existing historical gold district. So we're aiming to be producing 150,000 ounces per annum in 5 years' time. We are aiming for open pit mineralization to do that. Open pit mineralization is faster, easier, cheaper, and safer to find, develop, and operate. And what that means when we think about where we're focused is we are focused mostly around our Tarkula and Tunkillia projects there, which I've just circled on the screen. And the reason for that is that Tarkula and Tunkillia, again, there's about 3,000 square kilometers of land. We have over 100 kilometers of known major structures on those 2 project areas. They're 70 kilometers apart, so they actually function as one giant project. Essentially, they're satellites to one another. But on that 100 kilometers or more of structure, on less than 2% of that, we already have 1.2 million open pittable ounces. So again, we think there is real multi-million ounce potential here. Everything that we have touched here has turned into another new zone of gold mineralization. And what we're doing is breaking this down and essentially looking at sequencing and development where we can leverage our existing high-grade open pit and our fully permitted mining lease at our Tarkula project in conjunction with our mill. So that high-grade pit, the one you saw on the cover of the presentation, was producing ore to our mill during 2018. It was producing an average of 3.8 grams per ton. So we have proven, fully permitted mining leases, proven infrastructure, proven logistics, proven metallurgy. We can use that to start a smaller scale of stage 1 operations, let's say 40 to 60,000 ounces per annum. generate free cash flow, become a producer, re-rate ourselves both in terms of our equity and our credit profile, and then use that cash flow to expand into stage 2. And that stage 2 is where we're looking to get real efficiencies of scale to further compress our operating costs per ounce, as well as increase the number of ounces and step up to 150,000 ounces per annum. And that's where we're focused on Tunkillia, because Tunkillia is big, broad, bulk, open pit mineralization. And that is where we've had our recent resources updates. So we've just added 189,000 ounces of new gold there on that project. Now, the reason why we are focused on Tunkillia as stage 2 is because big, broad, bulk, open pit mineralization works better than anything else every time, all the time, in terms of thinking about unit costs, unit efficiencies of scale, and profitability. So a well-run bulk open pit where you have broad, continuous mineralization, you're essentially running a bulk open pit iron or coal style operation, but you're mining gold instead. So you can use larger buckets, you can use higher throughput at a mill, you can bring your unit economics down. And we actually profile a group called Capricorn Metals. They're another ASX listed company. They acquired a project called Karlawinda back in 2015. And when we were looking at this particular asset being Tunkillia, we saw in the raw data something that was starting to had some hints of potentially being a Karlawinda. Now, the Capricorn team acquired this asset as a 650,000 ounce asset back in 2015. They grew it to a 900,000 ounce asset, 1.3 and 1.1, 1.3, 1.5. And they focused on a large scale bulk open pit development. Now, it should be said, Capricorn, this is a team that have done this successfully with multiple lower to moderate grade open pitable assets across Australia for 20 years. They are the best in the business, but they have demonstrated that this big bulk open pit style of mineralization is the way to go. They've grown this asset to a 2.3 million ounce resource. The resource grade is only, we might say, 0.7 gram per ton. And today they're running an operation that's processing 5 million ton per annum. The average head grade, the reserve grade, and the average throughput grade at the mill is around 0.9, 0.95 gram per ton. And they are today Australia's lowest cost gold only producer. So they're producing gold for about $1,200 Australian per ounce, or about 800 US per ounce. So really bottom of the cost curve, very impressive profile, all based on high volume efficiencies. And so we are really growing Tunkillia and now modeling it to emulate this larger scale, more profitable, more efficient model. So what have we been doing along the way? Well, we've been building quite a bit of momentum as we move forward. So we have been bringing a lot of new technology into the region. We're essentially taking a region that sort of has been left standing still in the 90s and rapidly accelerating it forward. 1, to grow resources, and 2, to build a really large scale development pipeline that can take us out over 5, 10, 15, 20 years. We are also leveraging that asset platform. So we do everything from dispose of surplus equipment that we don't need. We rent our camps to third party, private and government operating in the region. And we even extract gold from our mill. So we did a mill clean out last year during the early part of the year, and we sold $1.5 million worth of gold from the gold room last year. And this year, in December of 2022, we also actually disassembled the gravity circuit of the mill. We were looking to preserve that material and look at an optimization of the gravity circuit. And we actually took another 10 tons of gold gold bearing concentrate out of the gravity circuit. So that's something we're also going to process and sell. But the net result is that we are investing quickly. We're discovering quickly. We found already 4 new gold zones. We've almost doubled our known gold mineralized strike around that sort of 1.2 million ounce resource package. The South Australian government has been a great supporter. They've given us nearly $1 million in grants. We've generated net of costs about $5.2 million in non-dilutive cash by monetizing our assets. So that is why we've 21 months after a $15 million IPO with a 24-month budget, we still have we've spent less than half of that cash net, because we've been investing aggressively, but also generating cash aggressively. And what we've been doing most recently with that investment is, 1, finding these new gold zones, but 2, also now going and testing aggressively the growth theses we had around our assets. So The big news last week is that we have grown the size of the 223 deposit at our Tonkilia project. This is the second time we've grown that. Much like the Karlawinda progression, we acquired Tunkilia in 2019, the end of the year, early 2020. It was a 558,000 ounce resource. We grew it to 965,000 ounces in October of 2020, and we've now grown it to 1.15 million ounces today. What that is in summary has been about a 45% growth in tonnage from October 2020 to today. We've added about 20% of the gold inventory, so another 189,000 new gold ounces. And importantly, the really important thing there is we've actually added those ounces for an extremely low cost. So that's been $12 Australian per ounce all in. So absolutely every single cost involved with the drilling and assay and technical work and labor and all these things on those ounces, or about $8 per ounce US. So again, a very, very efficient extension of resource there. So we'll look at Tonkilia here, and we'll start with Tonkilia in terms of the asset package. Obviously, this is our update, but this is thinking about where is this 5-year plan taking us. And the really interesting thing when you look at Tonkilia is we have this very, very large shear zone here, this Jarl Brinda shear. And we also have the Yurda shear skirting around the north end of our tenements. We've got about 50 kilometers of shear zone strike on and skirting our tenements. And these are very broad Kalgoorlie style shear zone systems, so kilometers wide. And there's a very interesting triple point of geology in the region. So there's a lot going on. And where we have been focused, where we've been growing resources and new mineralization in the first instance is this northwest area of the tenement here, where we have that 223 deposit. Now, when we zoom in on that, what we're looking at here is an area that in only about 5 or 6 kilometers along the shear there, we've already mapped out multiple new gold zones. So the original footprint that we acquired of the 223 project there is that 2 kilometer long footprint. Now, the 223 deposit, we had a very strong suspicion had room to grow from when we bought it. And the reason is that when you look across the drill hole database that we have there, we acquired a nearly 280,000 meter drill hole database there. But we've now grown that to around 300,000 meters of drilling with our own drilling. And of that 300,000 meters, about 80% of that was drilled between 1996 and 2005, when the US dollar gold price was below $400 per ounce the entire time. The next 10%, the next sort of 25,000 meters, was drilled with an average gold price of about $600 per ounce between 2005 and 2008. So the weighted average gold price at which these meters have been drilled for about 90% of the historical drilling has been about $400. So you've had this historically restricted search domain. You can only drill so deep when gold is only so valuable. Obviously, that gold price today in US dollar terms is quite literally 5 times higher. So our thesis was that we would test depth extensions of that known mineralization, but that we would also find repeats of that mineralization. We have also found 3 new gold zones at 223 North, Area 191 and Area 51. Area 191 is interesting because it's actually the other side of the shear. So both sides of the shear are mineralized. And Area 51 is turned into a 700 meter long zone of mineralization that has a higher grade core. And that happens to make Area 51 look a lot like what happened at the 223 deposit. We actually validated a higher grade zone there in the middle. So we think that the 223 deposit will continue to grow again. Again, we've grown it twice. We think we'll continue to grow it. We've identified more low-hanging fruit on that deposit. We are going to look at potentially converting the other 3 new gold zones into exploration target or resource. And then we're going to go down the shear. So we've got another 20 to 25 kilometers of untested shear in what is now clearly a very richly mineralized target. When we look at the 223 deposit itself, the long section you can see on the page here shows you the base of the pit that we modeled in 2020. That's the green dashed line. And what you can see is that that came up to a very shallow level in several places where historical drilling was quite shallow. So our thesis was that we would find significant extensions to depth in the north, central, and southern targets. And indeed, we did validate those. So we have 50 to 150 meter extensions to depth. We've also strengthened up a central higher grade zone there where you can see there's a lot of sort of purple and red dots of very dense high grade drilling. Again, the extension of resource that we've added here, we've done this for only $12 Australian per ounce on an all-in basis. Another way to look at it is for every meter we've drilled, which is about 11,250 meters of drilling that went in at a cost of about 2.3 million Australian. For every meter we've drilled, we've added 16 ounces, which is a very, very high payback. So we're excited about the value of continuing to extend this, and also the value of finding repeats of this mineralization as we go down the shear. Now, one other thing to point out, the way that we've modeled this, we've actually been very, very strict in our modeling. So we are modeling this not necessarily as a promoter per se, but actually from a production mentality. So we've actually modeled this the way that we would expect it to be developed if we were following that Carlo Winda style, big, broad, open pit style of model. So we've trimmed off and been even stricter with our sort of leapfrog modeling, or our domain modeling. We've actually imposed much stricter grade capping than we did in October 2020, and we've actually allowed additional internal dilution, as though we're going to mine this as a 40, 60, 80 meter wide body of mineralization, because you're not going to slow down to take out 2 meters of waste when you're in an 80 meter wide body. So this has given us a resource model that's very defensive in terms of its grade. We're thinking of this in terms of a high degree of reconciliation in actual operations. And it's something that gives us a lot of confidence to move forward on, not only in terms of extending this model, but then looking at putting it through a feasibility study and actually putting some real hard numbers on what that profitability might look like. And there's some interesting things that come out of the characteristics of this model as we start to look at the geometry of it. So the image you can see on the left here, this is an oblique 3-dimensional long section of the resource model. And all those different colors there, you can see these are different domains of the mineralization. And lying across the top of that, there's a 2 kilometer long, all the way along the top of the mineralization there, a thick supergene blanket of mineralization. So this is an enriched zone of mineralization at the contact point between the fresh and the weathered zones. And this is a body of mineralization that's 5 to 10 meters thick along the length of the deposit. It's 100 to 200 meters wide. It sits across the top like a blanket. And there's 225,000 ounces of gold in this shallow blanket. And then when you look at the image on the right, you're looking at a cross section through the middle of the deposit. And we have, as I mentioned, validated that there is a higher grade zone in the middle. So there's a 300 meter long zone of mineralization where at its core, we're looking at a model where you've got a 80 to 100 meter wide body of mineralization. So the kind of thing that you get very big bulk equipment in, you're driving an 8-lane highway through this material. But in the middle of the deposit, there are 20, 30, 40 meters of mining width where you're going to be mining up to 10 grams per ton. So there's an economic concentration in the middle of this deposit, which means we can start to think about now, okay, you're going to develop down on that high grade central pit. That's going to pay back your development capital. And then you're going to start opening this up along the length. And as you're laying back the walls and going north to south, that supergene blanket's going to pay for you to do that. And then as you start going down into the main body of mineralization, you get big, bulk, steady, open pit style operations that can then hopefully be capable of paying some very attractive dividends as we get into full scale operations. So we're getting, and I'm cautious to say we haven't yet put a feasibility study around this, but this is something that's starting to get very exciting for us, particularly as we think about scaling this a little bit more and continuing to boost those economies of scale. And then everything we've looked at there around that 223 deposit sits just within this northern circle you see here, this yellow circle up north. You can kind of see a Christmas tree of mineralization there showing up in our geochemical and drill hole figures. We have got another 25 kilometers of shear zone north and south where we've already started to find lookalikes for that style of mineralization and some very interesting dilation and deflection zones in the shear. So we think that essentially this is a neighborhood. We own the neighborhood. We already have a 1.15 million ounce corner house. We're pretty sure it's not the only one, and we think this has real district scale potential. So thinking about that, that's the big picture. The question is, how do we get from today to year 5? And also thinking about, if you had big, broad bulk open pit mineralization, what you love to have is some high grade mineralization nearby that you can actually use to average that up. Because if you could put high grade blend in with that big bulk mineralization, that's essentially cream and pure profit. And this is where Tarkula comes in. It's very interesting. So Tarkula, again, is only 70 kilometers north of Tunkillia. It is functionally a high-grade satellite to Tunkillia. And this is where we have our mining lease, this mining lease 6455. Now, this was the site of South Australia's gold rush. So at the same time that Western Australia had a gold rush in the late 1800s, South Australia had a gold rush. And on our mining lease, over 600 shallow little open pits and adits were dug, where the old timers were there mining high-grade gold out of quartz veins at over 1 ounce per ton. And they only got the little veinlets that were coming to surface. When you fast forward 100 years, a mining lease was put on there and a small open pit was opened. And that's the one you saw on the cover of the presentation. Now that pit was producing about 3.8 gram per ton on average to our mill during 2018, processing with about 94% recoveries. And we have multiple repeat targets both adjacent to the pit as well as across these sort of 10 kilometers to the west. So this is a simpler, lower cost and lower risk way for us to use our existing mill, use our existing mining lease, use proven logistics to basically start operations without having to build a new mill, generate that free cash, and then move into expansion. Now, when we look at that pit itself, just for a bit of perspective, this is a long section of the pit. The south is on the left, the northeast is on the right. This was a very shallow pit, so it was only developed to about 70 meters deep at its deepest in the south. And when the former owners had it, they actually went out of business, so they had to stop operations quite rapidly. What you can see in the bottom of the pit floor there is actually high-grade mineralization sitting in the pit floor. We've drilled below the pit and we've extended mineralization to depth about 200 meters. And we've also drilled along strike. And this is where it gets more interesting because we found an entirely new gold zone, which we called Perseverance West quite creatively. And this is shallow high-grade mineralization where we could go into the existing pit and just go straight through the south wall and into this mineralization. So that's very exciting. But the bigger picture really is the bigger picture. The image you see on your left here, this is an image now that's the size of the mining lease. We've identified 3 targets that we think may host repeats of that high-grade open pit. These are targets that are analogous in terms of structure and mineralization, historical high-grade mining, both surface and underground. So we are going to go this year, we're actually going to be doing some more seismic work to sharpen up our subsurface resolution and test targets on the mining lease, but also on the 10 kilometers to the west of the mining lease. So the image you see on the right here, what you can see there is the location of our mining lease there. That's the Perseverance mine. And what you can see is we've mapped using seismic the major structure that fed that high-grade pit, and that's called the Perseverance Shear. Now, if we swing our attention all the way to the west side of this image, now this is our Warburton target. This is about 10 kilometers west. And what we've done with seismic here is we've gone and created a map of these subsurface structures. Now, we're the first people to do this in this area. And what's interesting is the Warburton target, this is an asset that was known to be of interest back in the mid-90s. So Anglo Gold actually drilled a hole in 1997. And they got 16 meters at 3.5 grams per ton from surface, which is a very exciting drill hit in today's terms. But in September of 1997, the gold price was $300 and falling, so they didn't follow it up. However, they drilled that blind, if you will. They drilled that on a geochemical signature only. They did not understand this structural, the underlay that's here. And what you can see is we have the Perseverance Shear that's coming up here. And it passes through what we call the Tarkula formation here. That's the mineralizing basin. And it plumbs directly into one of these red outlined bodies. And these are large granite intrusive bodies called the Hiltaba intrusive granites. They are the same engines of mineralization that sit under Prominent Hill and Olympic Dam, which are about 200 kilometers to the east. And what you can see here is perhaps more interesting is that we've mapped a series of parallel and cross-cutting structures, which are perfectly analogous. So these are structures like the one that points to Warburton. They pass through the same mineralizing basin. They plumb into the exact same intrusive body. And where we have Warburton on the west, and we have the high-grade mine on the east, we actually have a collection of targets in the middle that we had already worked up as very high-priority, interesting targets. And we can now see, indeed, quite literally after the fact, there are structures that are pointing right to surface where we had mapped these things out. So if Warburton is exciting in the west, if Perseverance Mine is exciting in the east, we think that this basically lays out a field or a cluster of potential high-grade pits, which would be very interesting for stage 1 high-grade feed, but also a source of long-term consistent high-grade blending feed for stage 2. So it's been a very busy year for us already. It has been a transformative year. It's going to continue to be. 2021 and 2022 post-IPO were really about proof of geological concept. 2023, we're now putting hard numbers on the board in terms of growing ounces. And where we've come to now is not kind of the last step for us. It really is just the first step. We bought these assets privately at the end of 2019. We spent about $10 million doing work privately before we IPO'd them. And we want to come to the end of the year growing them further. So we are going back into field now. We're going to pursue additional extensions of that same mineralization at Tunkillia. We're going to be targeting new structures that we found that previously have not gone into resource modeling. And we're also going to be testing down the shear at some really high priority discovery targets. And of course, we're swinging that camera lens as well back to Tarkula. We're actually going to be doing some additional seismic work shortly. And then we're going to go test our favorite 5 or 6 targets across that field of new structural high-grade targets there. The idea is we want to come to the end of 2023. We want to grow Tonkilia resources again, really crystallize that big bulk long-term picture. And we also want to start putting some hard ounces on that high-grade open pit, as well as mapping out repeats of that pit so we can see the roadmap, if you will, to stage 1 operations as well. So for us, it's been an exciting year. It's going to continue to be an exciting year. We've built a pretty unique platform in the area, and we're very carefully leveraging that to build itself into long-term gold leadership. But of course, we're growing those ounces quickly. We're very well capitalized to continue doing that at pace. We expect to be drilling another 20 to 25,000 meters of RC and diamond drilling through the balance of the year. We're very well capitalized to do that. We have an excellent team leading this program. And of course, while we have put out a lot of news in the past 21 months since IPO, we expect to put out a lot of news between now and Christmas as we look to crystallize further resource growth by the end of the year, and then start looking into studies for developing these assets and getting stage 1 operations up and going. We'll start looking at that in early 2024. So thank you very much. That concludes the presentation, and I am certainly very happy to answer any questions.
Great. Thank you, Alex, for a very informative presentation. We will now start the Q&A portion of the webinar. Reminder to everyone on the line that you can type your questions into the chat box at any time. And we already do have a couple of questions, and I think you had touched on this one, but what is your drilling cost per meter and what is your discovery cost per ounce?
So we think of our budgeting from a drilling standpoint as an all-in cost. So when we think about RC drilling, we budget at $200 Australian per meter all in. So that's the drill, the assay, the infield logistics and support. That's technology costs, licensing fees, and then even we include in that our resource estimation costs where we're doing resource work. So it's a really useful tool for us if we think about doing 5,000 meters of RC drilling. You can put a roughly 1 million Australian dollar figure on that, or about 650,000 US. Diamond drilling is a slightly higher cost on a per meter basis. Obviously, it's slower. We budget about $250 Australian for that. Again, we're pretty efficient in field. Whether it's 200 Australian for an RC meter or 250 for a DD meter, that's very competitive in the market. And again, that's because we can use our existing asset platform. We don't have a lot of infield logistics costs and accommodation costs. We don't need to mobilize remote camp. We have villages and camps at all of our assets, so we're able to use that quite efficiently. And then the second part of the question, our cost to date for new ounces that we've put on. Since we've become public, this is the first resource update we've done. So that was 189,000 ounces added for $2.3 million on an all-inclusive cost basis. That's Australian $12 per ounce, or about US $8 per ounce of new ounce for that update.
Great. One question that's always popular, but how much cash do you have currently and how long will that last with your current plans?
Yeah, so we had $8.3 million Australian at the 31st of March. So we just put our quarterlies out, and so that number is about 6 weeks or sort of 5 weeks old. We are very sort of cash efficient. So if you look at our net cash consumption on a quarterly basis, despite all of this work that we're doing, and so again to recap, we've done about 31,000 meters of drilling since our IPO. Which is 7 quarters of work, 21 months, 7 quarters of work. We've also done 5 or 6 geophysical programs. And of course, we have our corporate costs and corporate development. We've even done some early works on our mill to look at optimizing the gravity circuit. In all of that, we've only spent net $6.7 million. So we've actually spent less than $1 million Australian per quarter while doing all of this work, or about net $600,000 US. So our standstill costs for most people generally are our aggressive heavy work costs. We can keep going for quite some time on our current cash. Again, if we wanted to say budget indicatively 25,000 RC meters equivalent. That on an all-in basis would cost us about $5 million. So we can more than cover that work by the end of the year and still have plenty of cash. We'd still have, in theory, over $3 million in cash. But again, one thing I'll flag is we continue to monetize our assets. So we took 10 tons of gold-bearing concentrate out of our mill in December. We haven't processed and sold that yet, but we sold $1.5 million worth of gold last year and early this year. We may have another, $1 to $2 million worth of gold that we might be able to recover from that. We still have surplus assets that we can sell. We still have camp and stuff that we will rent to people in the region. So we expect to generate some additional cash as we go forward as well and continue to build that cash buffer. So we're in a very good, uniquely comfortable position as an explorer developer.
Great. One question here, and you had mentioned kind of the plans, kind of staged plans for the operation, but the Central Gawler Mill currently has a capacity of 650 tons per day, which is on the small side for an open pit mill. But can you tell us more about the expansion plans for the mill for future production?
Yeah, so that mill has it's 650,000 ton per annum, so it's about 2,000 per day, or 1,800 and change per day. And that mill would be designed to service Tarkula as an operation. So that actually would be sized relatively well for that. When we think about the long term, going into stage 2 expansion, we would actually build a new mill next to Tunkillia. And the reason is that we would be looking at big, broad bulk open pit operations. So you'd be looking at something that's much more like a Karlawinda model, something that's like 5 million ton per annum. Because if we think about, and it's useful to think about the unit economics here, the unit economics and the efficiencies of scale are non-linear when we think about how these things work. The current mill that we have at 650,000 ton per annum, it costs about $30 per ton to process 1 ton of ore going into that. And then about $5 of administrative costs or so. So you've got about $35 of just processing and admin costs, which is pretty good for a mill of that size, actually. When you go to a mill that is 5 million ton per annum, your milling costs might be closer to $10, $11, or $12 per ton. So for $35, you can actually do your drill, your blast, your mining, your movement, your processing, and cover your administrative costs. So it's literally 3 to 5 times as efficient as a smaller mill. So we would keep that existing mill where it is. We'd use that to generate a lot of free cash with the stage 1 operation, build that new mill, and then we would actually have 2 mills 200 kilometers apart that give us a lot of optionality to look at consuming gold in the region. So thinking about toll milling or even acquiring other assets with a number of junior explorers who've come up around us right now and are building resource ounces.
Great. And there was one question kind of following up on that. Is there the potential to acquire more ground in the area?
There certainly is. So, we already have a very substantial package. We quote things in terms of square kilometers, which is, multiply it by 100 for hectares, and then another 2.5 for acres, if you think that in those terms. It's a phenomenal area that we have already, 500,000 hectares. There is a lot of very interesting ground around us. What I would say is we have so much structure on our ground currently that we could spend $500 million in 30 years here and never run out of really interesting things to test. But the opportunity, if we think about the bigger picture, we are leveraging these assets into low-cost operations. We've got a huge advantage there, and then we can use those operations to fund our expansion. So, we're not, going to raise $150 million to build a mill for stage 1 because we already have that mill, and we can use that cash flow to go into stage 2 without having to raise $100 million because we've already got that cash flow. But then when we look out around us, there are people that are growing resources. We could look at acquiring that ground. We could also look, particularly as we have 2 mills running, we could look simply at consolidating the economics, right? So providing access to the mill, whether it's via toll milling, which, from a mill owner standpoint, is quite attractive, right? We're not taking the geological risk. We're not taking the operating risk, the grade reconciliation risk of the person who's operating that mine. We're just charging a dollars per ton basis to process their ore. We could also look at ore purchasing. So if they mine and deliver that ore, we can buy it based on the assayed content of gold. So there's a lot of different ways to achieve that same model, but our net intent, or sort of the goal we're going to, is to really consolidate that region and sort of be the long-term platform leader, both in terms of number of ounces we're producing, but also in terms of being an infrastructure operator where we're getting the lowest cost, most attractive slice of the economics if we're thinking about third-party ore.
Great. And obviously with some of your ground, it's fully permitted for production, but is some of it still not permitted? And what is the permitting process like in South Australia?
Yeah, so large portions of our ground are not permitted for operation. So you have mining leases where you've converted from a portion of an exploration license to a mining lease, and to do that you have to demonstrate an economic proposition. You also have to demonstrate that you've done the environmental analyses and rehabilitation planning and all of these things. So we have existing mining leases both at Tarkula and up around our Central Gawler mill. We have fully permitted miscellaneous purpose licenses there for our operations. And we also actually carry our EPA license. That's actually a really important point. We don't need to spend 2 years getting our EPA license again. We can essentially turn on our mill when we want to turn on our mill. In terms of thinking about other ground, if we go out on the exploration licenses and we find something that we think is really attractive, obviously you need to turn it into a resource. Then you go and apply for a mining lease, and that is that in conjunction with your mining approvals is going through the environmental and hydrology analyses and demonstrating to the state that you're going to be a responsible operator and a good custodian of the ground, and you have an acceptable rehabilitation plan. That's that's sort of an 18 to 24 month process to do, which is why it's really, really valuable that we do have these fully permitted mining leases. We can start operations while then bringing other areas into mining lease and then bringing those on in operation. So we can sequence this carefully, but nicely and move smoothly through that growth curve. Great.
Well, I suppose one question I'll ask just to finish things off here, but just to review, what news might we expect to have over the coming weeks and months from Barton?
Well, we have just obviously put out a pretty significant resource update, and we are quite literally already going back out in the field and doing new clearances for new drilling. So we will expect to see drill rigs mobilizing again around mid-year for very aggressive drilling at Tunkillia. So that will be, let's call it extensional drilling to look at growing that 223 deposit again. It will be conversion drilling to see if we can convert some of our new gold mineralization into exploration target and potentially new resources as well. And then it's discovery drilling. So filling in that discovery pipeline down the shear zone and seeing if we might not get an early look at where is the next, where the next 1 to 2 million ounce style deposits like the 223 deposit. At Tarkula, we're also going to be going and drilling on that existing open pit adding resources there, and then also testing some of our highest priority targets for repeats there. So very aggressive resource growth, extensional and discovery drilling as well by the end of the year. The idea is, again, to come to the end of the year with further resource updates at both of those assets and really crystallize that medium-term stage 2 pathway to scale, but also start to crystallize that stage 1 pathway to operations. And then just for a bit of fun, we will also be selling some gold, and we've got a few other interesting little things we're working on. So we've got a few cards up our sleeves that we're not talking about yet, but we tend to like to surprise the market with good news, and we'll continue to do that.
Great. Well, I would like to again thank Alexander Scanlon for presenting today, and thank you everyone on the line for tuning in. Just a reminder that Red Cloud Securities will be back this afternoon when our webinar series continues with Luminex Resources presenting Tuesday, May 2nd at 2 p.m. Eastern Time. Have a great rest of your day.
All right, thank you.